I think that's important for Ecora and for any investor who evaluates a royalty company investment, which is just how much of the portfolio and how much of the value is tied to assets that are already in production and how much of the growth is coming from assets that are not yet into production. And then you can evaluate that, of course, to the entry point. And I think today, when you look at the Ecora entry point, what are you paying for? And the Ecora share price has moved a little bit since the slide was put out. But still, the entry point today is not too far away, adjusting for net debt from the value of the producing assets.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today, we're joined by Marc LaFleche, CEO of Ecora Resources. Ecora is a royalty company that focuses on energy, electricity, and battery metal royalties. They are spread across 5 continents. They have a lot of producing royalties and many in the pipeline, and the commodities that they mainly focus on are copper, cobalt, nickel, uranium, vanadium, and rare earths. They also have met coal. I was introduced to Marc at the 2025 Rural Symposium and have since become a shareholder, so that conflict of interest is now out of the way and stated. Marc, thank you for coming back on the show.
It's a pleasure, Steve. It's great to reconnect. It's been a lot has happened in the short period of time since we last spoke. It's great to be back.
Yes, it's well, thanks for being had. I like to start all these company interviews out with a quick overview so people get an idea of your company, market cap, cash, and debt.
Yeah, so Ecora today has a market capitalization of just over $300 US dollars. The share capital structure is 249 million shares, very sort of clean, no warrants or anything like that. And debt of 108 million. We drew down on our revolving facility to fund the purchase of a $50 million producing copper royalty earlier this year. And that debt number is, as I'm sure we'll discuss later in this call, coming down very quickly.
Awesome. So 300 million, and how much do you have cash?
It's a net debt number. So the net debt number is right around 108, actually, adjusted for a transaction at the half year number.
Oh, okay. So that's what you could finance if you wanted to pull from it. And okay, let's go into for those that didn't see our interview in the Rural Symposium, go ahead and go over your background and how did you become the CEO of Ecora?
Yeah, well, I joined Ecora in 2014, which doesn't feel like a long time ago, but I suppose looking at the year of 2025 is 11 years now. And prior to that, I worked in investment banking on a variety of capital market transactions, M&A transactions, also on leverage finance or high yield issuances for a brief period on a rotation. In 2014, the opportunity came to join a royalty company, which I thought was pretty exciting. And in many ways, it's what keeps me excited about Ecora today. And that is Ecora is a fairly differentiated royalty company. I mean, there are a lot of royalty companies in the world offering exposure to precious metals. Our portfolio is somewhat unique, although not the only royalty company with this strategy, but in the wider universe, definitely a minority, where more than half of our assets, our estimated value is in copper, 80% in base metals, and as you mentioned, some of the commodities already, rounding it out with uranium, vanadium, rare earths. And I think Ecora, in that sense, provides investors with the merits of the royalty model, but with the commodity exposure to a suite of commodities that, in some instances, are pretty difficult to get exposure to in a de-risked way in some of the larger mining companies.
Yeah, so 50% is in copper, and what are you defining as base metals?
In our base metals exposure today, we would have copper, cobalt, and nickel.
Copper, cobalt, and nickel. Okay, awesome.
And for anyone sort of interested in getting a better feel for our mix, stage of development, geographic exposure, cost curve position, in our corporate presentation available on our website, slide 23 is a great snapshot to give you a feel for all the aforementioned portfolio characteristics.
Okay, I'm going to be Johnny on the spot here, and we're going to go to slide 23, sir. And this is, there we go, slide 23. All right, walk us through what we're looking at here.
Yeah, so I think we've touched on the commodity exposure, and I think the key point to note is our copper exposure has been very deliberate.
Mm-hmm.
And I suppose many of the commodities in our portfolio more generally, in that sense, they always, the old adage, Steve, the best time to plant a tree is yesterday. And we've been very, very deliberate in terms of how we built these exposures for many of the market dynamics in anticipation of many of the market dynamics, which we now see playing out. And we can probably come back to that later in our discussion. In terms of geographic exposure, equally deliberate in terms of the jurisdiction footprint. We've really been deliberate to keep the vast majority of our portfolio in the OECD region in Brazil. And when we have sort of gone elsewhere, it's been into really well-established mining operations and really well-established mining jurisdictions and operations that either are or expected to produce very low in the cost curve. So in other words, targeting really high quality ore bodies. The portfolio, it won't surprise anyone because we always say it if anyone has heard us speak in the past, but we've also been very focused on getting exposure to assets that produce at a very low cost of production and thus have the ability to generate cash flow through commodities price cycles. So in other words, very defensive royalty exposures. And second, over projects that are expected to be low cost because these projects typically have the best economics and thus are expected to come into production the fastest. And once they're in production, stay in production the longest. The last point of our portfolio, which you touched on already, Steve, but again, is kind of unusual for a company of our size, is the weighting of our portfolio to assets that are generating cash flow today. And more than 55% of our estimated asset base is over royalties generating income. So while Ecora absolutely has a fantastic growth pipeline, I think that's on top of what exists in the here and the now and the cash generation that the producing asset base has in it.
Okay, let's get into some of the meat of it. So the commodities that we're investing in, we went over, and about what percentage of your income is coming from each of those commodities. So just run through, met coal, copper, and about what are the percentages?
Yeah, so if you'll forgive me and don't mind flicking back to another slide, I think that's really is a great background to this question. Mm-hmm. And that would be slide number 4 of our corporate presentation.
And slide number.
The Ecora historically has really been, as you mentioned, weighed towards metallurgical coal, mm-hmm. Right? And that's what you see on the chart on the right. And I think that's important for anyone who looks at Ecora to understand is kind of where we've come from and also where we're going. And if you went back to 2020, what you'd see in that chart on the right is the gray box representing primarily steelmaking coal. With the yellow line being specialty metals and base metals. So in other words, a portfolio 5 years ago, very weighted towards metallurgical coal. 2025, it's a very exciting year for us and this business in the sense of our portfolio and the producing asset base demonstrating the cash generation potential that exists. And this year, for example, is expected to be the first year, at least in the time I've been with Ecora, where more than 50% of our revenue is expected to be generated from base metals and critical minerals, which is a really important milestone. And if you look 5 years into the future in terms of where we're expected to go, that's what that last column represents. So the blue line represents the expected royalty income or stream income from assets in base metals that are already in production. The yellow line being specialty metals and uranium. And then the shaded blue line just representing the near-term growth that at this point that is expected to be generated by the end of 2030. So to put it in other words, you have a portfolio of producing assets. It's expected to generate $50 million a year. Pick your commodity prices, probably more if you run spot prices, and then with potential to more than double based on the growth that we have in the short and medium term. And then beyond that, of course, there's a longer pipeline of growth. But I think that's key to understanding Ecora in the context of Ecora having historically been a lot of cash flow from met coal, which is very much out of favor, but a lot of growth in commodities that have really strong fundamental, structural, longer-term outlooks.
Okay, so we could see as time progresses here that the income stream from a lot of these base metals, copper, cobalt, and nickel, will increase, and then new ones. This hash graph one up here is new ones that are going to be coming into production or forecast to come into production, and this gray one is the met coal assets that are pretty quickly going away, but you hope to find a sweet spot as we generate new income streams, and those being in the base metals.
And I think that's important for Ecora and for any investor who evaluates a royalty company investment, which is just how much of the portfolio and how much of the value is tied to assets that are already in production, and how much of the growth is coming from assets that are not yet into production. And then you can evaluate that, of course, to the entry point. And I think today, when you look at the Ecora entry point, which is illustrated on slide number 5, what are you paying for? And the Ecora share price has moved a little bit since the slide was put out. But still, the entry point today is not too far away, adjusting for net debt from the value of the producing assets. And effectively, all the growth from the development stage portfolio doesn't appear to be priced in. So in that sense, a very defensive entry point for someone looking to get the exposure, benefit from the growth potential that exists in the company, but priced off of, underpinned by the value of the producing asset base.
Yes. Okay, let's get on to some listener questions here. And thank you to Patrick and to Create for submitting them. He's asking about Kestrel. So revenue from Kestrel is expected to be broadly similar in 2025 that it was in 2024, about 41 million, then around 20 million in 2026, and then 4 to 6 million in 2027. He's basically asking if his numbers are about correct, and that's the met coal asset.
Yeah, so on the met coal piece, I think to the point I sort of discussed earlier on that slide, I think this year actually we're expecting to see quite a lot of our growth in our non-Kestrel assets and a step down in Kestrel. So broker consensus this year for Kestrel on the full year is just under $20 million, so 18 and change. Next year, around 12 and 12.5, and then stepping down to that sort of 4 million mark in 28.
Okay. And then Voisey's Bay. So Voisey's Bay is the Cobalt asset. If we expect Voisey's Bay to be near 20 million annualized by the end of year 2026, and Mimbula ramp up contributing around 10 million in 2026, can we expect about a 15 million dip in 2027, partially offset by the final 9 million in South 32 payment?
Yeah, so let's start with the South 32 payment. Those payments have all been completed, have been made in full, so there are no more outflows associated with that portfolio of royalties we acquired in 2022. And in fact, the final payment was made sometime last year. When you look at the forecasted revenue line, at least on broker consensus numbers, that number doesn't really move below 50 million, and consensus for this year is around 53 million. And there's probably actually quite a bit more upside when you think of cobalt prices and copper prices, and to some degree uranium as well. But why don't we just start with copper? I mean, the copper market, as a result of disruptions in supply, which represent an estimated 4 to 5% of total production, is expected to be in a supply deficit. And actually, other commentators have forecast that the copper market is expected to show a deficit in terms of quantum that hasn't been seen since 2004. So the copper market backdrop in the next 12, 18, 24 months is really, really strong. You're in a position today where physical inventories are fairly tight, although the US has seen higher levels as a result of trade flows earlier this year and potential tariffs. But globally speaking, inventory levels are very tight. We're in a position now where the market appears to be undersupplied. You're expected to see very strong demand growth continue in the next short, medium, and long term. And from the supply side, new copper supply is difficult. You're moving to higher cost ore bodies out of and jurisdictions that can take more time to develop sizable operations. So when you put those two confluence factors together, we're starting to see research analysts markedly up copper price forecasts in the short and medium term. In fact, I saw one bank today move their long-term target price to 10,500, which is pretty substantially above where long-term prices have been historically.
What this is price per pound. What is that in price per pound? I don't.
Okay, I think in LME terms, so if you'll forgive me, but that's right around 470.
Okay. Right now it's just south of $5 a pound.
Exactly. And when you think about that long-term price, that's well below the forecast for the next few years that we're seeing come through. But also, you also need to think about it in the context of the Ecora entry points historically. So our copper acquisitions really started at $3 per pound long term, and a number were made in the threes, or recently in the sort of low mid fours. So I think the portfolio is really well positioned in the longer term for anyone who's quite constructive on copper by virtue of the entry points. And furthermore, it's important to keep in mind the royalty model is such that you effectively receive the top line, right? So 20 years ago, the copper price, or maybe slightly more than 20, was right around $1 per pound. And I don't know if it'll be 4 times the price 20 years from now. But with the royalty model, you do capture that inflationary trend that you see in commodities generally. So that's copper. On cobalt, again, I think a lot of the forecasts that we see have not been keeping up with the market developments in the cobalt sector. So the big news around cobalt this year was the government of the DRC announcing in February or late January and implementing in February a cobalt export ban, whereby they were seeking to rebalance supply and demand. And you fast forward to a week ago, the DRC announced a cobalt export regime, which is set at initially anyways for the next 2 years, something like less than 50% or around 50% of 2024 production. So really we've seen a big tightening in the cobalt market. And you can see it on your chart. And then what's interesting is, we've seen a big tightening and a lot of noise has been made around cobalt prices and their movement in the past year, but actually on a historical basis, it's still well below peak historical levels.
Very cheap, yeah.
So there does appear to be potential for cobalt prices to move quite a lot, at least on a historical basis as well. And you are starting to see the impact of the efforts to tighten up inventory levels. So the inventories of cobalt that have been produced, held as intermediate products or as finished products in the system. And that is certainly putting pressure on the availability of cobalt hydroxide products, cobalt sulfate as a consequence. And you're starting to see cobalt metal actually being dissolved to feed the cobalt sulfate end market, cobalt sulfate being battery end markets, cobalt metal primarily being as an alloying agent, especially in aerospace applications. Any sort of metal that requires very heat resistance properties, cobalt does really well. And it's actually in a battery, right? Same sort of principle. In a battery, cobalt metal there can assist with thermal regulation.
Yes, this chart is very interesting to me because, as my brother put it, the kindergarten method is you basically buy on this end of the chart and you sell on this end of the chart. So seeing that you guys have such a big cobalt asset and we get to invest on this end of the chart, that just goes right in with the thesis.
And I don't know, Steve, if the price will go up to $40, $50 per pound. We'll have to see. Another scenario is the price sort of stabilizes at sort of a midpoint level and sort of stays there with less volatility. And in some ways, maybe that's a good thing, I think. So we'll have to see how it plays out.
Yeah, time will tell. Okay, so Voisey's Bay, Basically his question here is that we can all see that met coal is going to be dwindling out, right? And that's by design. You know, you guys are trying to move from being a coal royalty company into a electric and battery metals and energy company. And his question's basically like, do you see that, you know, that handoff of cash flow is going to be, I mean, that's got to be a difficult thing. You know what I mean? You guys are, I'm glad that you guys have such a good accounting background, but that's got to be a very difficult math problem to try to get a smooth transition. Is there going to be a hiccup along the way, whether that's in 2026, 2027 in that cash flow? What do you see there?
Well, first of all, it's not an easy thing to do, right? Um, as a royalty company, you don't control the development timelines, you don't control the operations, you don't control when the mining company will bring a project into production. So in that sense, yeah, and it's been, I mean, you know, I think we've entirely acknowledged that this transition has been bumpy at times. But I guess what matters in some respects is the direction of travel. And, you know, like the journey is important as well, but where are we headed? And in that sense, I think when you look at our H1 performance, we saw over 80% growth in the base metals assets. I think that just, which is really key to anyone who's sort of uncomfortable or nervous or keen to see a bit more comfort around the Kestrel transition. Just demonstrating the cash generation potential that exists, first purely from the assets that are already in production, goes a long way to giving some comfort about this transition from where the company was to where it is today and where it's going. Voisey's Bay, unfortunately, was delayed in its ramp up, which probably accentuated the concerns around what would happen as Kestrel came off. Would Voisey's Bay come quickly enough? And today, sitting where we are, we've seen phenomenal growth in the Voisey's Bay asset as a result of the ramp up. To give you a feel for it, Steve, in the first 2 months of Q3, we actually received the same amount of cobalt that we under the stream that we did in the entirety of H1.
Oh, wow.
So that asset is really hitting its stride. The asset is producing for 90 days earlier this year at just under 94% of throughput capacity. And it's coming at a time where we're seeing that volume growth with a really strong price background to really complement things. And therefore, I think when you look at the broker forecasts anyways, which is a function of production and of pricing, when you overlay some of the much more bullish developments that we've seen, and even just the last week for cobalt and copper, what you see is probably a growing revenue profile over the next couple of years from what was just flat previously, until we saw the addition of new assets coming online.
Okay, about what is your cash flow going to be for 2025?
Yeah, so from a portfolio contribution number, which is the top line level, the research analyst forecast for this year is based on consensus prices that, again, don't probably reflect some of the dynamics in the copper and the cobalt market at 53 million to, you know, between next year, 50 to 55, and then 50 again, and 50-ish in 2027. And then that picking up in 29 and really ramping up towards the end of the decade with the expectation of new projects coming online.
Okay, yeah. I was basically asking between the two bar charts of 2025 to 2030. There's a nice jump there, but is there a dip in the middle or kind of steady? It sounds like it's pretty steady until 2029, and then we get a really nice bump.
Yeah, the next 12 months, I think, really should go a long way to informing exactly what that shape looks like as well. You know, there are a couple of projects which are approaching a final investment decision stage, projects that are largely permitted, right? Projects that are sort of sometime before the end of the decade, but really putting a pin on when is a bit uncertain until the mining companies proceed with the capital allocation decision. So, you know, we haven't really gone into any huge amounts of detail on today's call, but for anyone who would like to unpick it all, I'd encourage you as a starting point to have to review slide number 13 of our corporate presentation, which really outlines the three dimensions of the growth that exists from the existing portfolio. Number one, just assets that are in production that are expected to produce more. Number two, assets that are in production that have the potential to see brownfield expansion. So in other words, increased production capacity. And then number three, from assets that are at development stage and being incrementally de-risked or approaching that final investment decision point. And you can see that on the left being the nearer term, and then on the right, sometime within the next 1 to 4 years.
Okay. All right. Let's see. Some other questions on any updates on Santo Domingo, Montes Blancos, Phase 2, and I'm going to mispronounce this, Piaui? How do I say?
Well, it's good timing to come to this slide.
Okay.
So I'm taking those in order. So Montes Blancos Phase 2 study is expected early next year or sometime in 2026. The next question some of your listeners may have or viewers is, well, what's Montes Blancos Phase 2? So if you'll indulge me, maybe I'll just give a bit of context and background. What do you think? Does that make sense?
Yeah, sure.
So the expansion of Montes Blancos has two dimensions. The first is to utilize existing crushing capacity that exists that would see mill throughput increase from 20,000 tons a day currently to potentially 27,000 tons a day. Again, leveraging a lot of existing equipment that results in a project that adds incremental capacity, but at a very low capex per ton or capital intensity per ton. So this Capstone have suggested that this could add 10,000 tons of production to what's already being produced from this sulfide circuit. And second is the potential to retreat waste material. So material that was deemed historically uneconomic or to retreat material that was already processed once. We shall see how much that split is to either of those categories. And that would be done in an existing copper circuit, an SXEW circuit that has excess capacity. So again, very low capital costs. So when you combine those two together, that's potentially 35,000 tons. And then you compare that to the midpoint of guidance this year of right around 54,000 tons is potentially quite material. So that's certainly something that many are tracking carefully. And we are very, very, very excited to see the results of that study to be published by Capstone as and when they're available. The second part of the question relates to Santo Domingo. Santo Domingo is a project also owned by Capstone Copper. It's located in Chile, very nearby the Manto Verde mine. And Capstone Copper has really highlighted the synergy potential that exists between the Santo Domingo operation, where it brought into production, and the producing Manto Verde mine. This project, in terms of milestones, the next key step is as the announcement of a potential partner. So Capstone Copper is following a cookie cutter approach to developing the Santo Domingo project, as they did to a recent project at Manto Verde. And Capstone has suggested that they are targeting the announcement of a strategic partner or a financial partner sometime in the second half of this year. So that really is probably the first step of, assuming all goes well, 3 key milestones, being the partner, and a final investment decision and start of construction, and then first production. And then last on Piaui. So Piaui is a very advanced stage nickel project located in Brazil. It's a project that has a fantastic team that have really engineered and designed this flow sheet and have a lot of execution capability that we found to be, as Ecora anyways, very impressive. The project has TechMet, which is a UK-based group, in part backed by the USDFC as a shareholder. And the company is in discussions with the USDFC, potentially in relation to debt funding. And the focus is really around bringing in the equity funding required to start construction. So this one here is one we're watching very carefully, because when you look at how the nickel market is evolving, you now see Indonesia representing approximately 70% of the world's supply of nickel or various nickel products.
Yeah.
That's potentially an uncomfortable position for the world to be in, right? Given a lot of that Indonesian supply is directly or indirectly controlled by China.
Yes.
And I think when you think about how the rare earths market has developed, cobalt market, many other commodities, to use a colloquial expression, we've sort of seen this movie before. So it'll be interesting to see what happens and how state actors look to secure supplies of nickels potentially in the future as a pretty vital ingredient to stainless steel and, of course, to battery chemistries in the future. In that sense, Ecora is exceptionally well positioned, though, to a cyclical turnaround of nickel with the Piaui royalty and also the West Musgrave royalty, which is a copper nickel project owned by BHP.
Yeah. Okay. So 2026 for Montes Blancos, Piaui. This one's interesting to me because I'm going to share my screen here on the nickel chart, and basically kind of looks like a dying EKG. This is when I get excited about a commodity, is when it just kind of looks like it just can't go any cheaper because it can't. And buying into those. About how long is it going to take for them to go? If you said they're getting close to construction, about how long is the construction phase forecast to last?
For Piaui, it's on the order of 2 to 3 years. I think the exact timeline to be seen. And there's further disclosures on the website from Brazilian Nickel. When I say 2 to 3, I'm also including some form of ramp up period as well, right?
Okay.
So the nickel point, though, I think the other thing to keep in mind if you're thinking about it on a cyclical basis is, well, what informs that sort of price that you see, and what's the risk of upside to downside from here? And when you look at how the Indonesian government has taken certain actions actually to bump up some of the marginal costs of production in Indonesia. For example, royalty rate regimes, minimum wages, much more restrictive permitting. It does suggest that, while we might not be going in a straight line from here by any means, it does suggest that cyclically speaking, you may have sort of seen the worst of it.
Okay. Yeah, from what I can tell from Facebook groups and just it's pretty opaque out there, but you can literally see the damage they're doing on Google Earth. If you zoom in to southern Sulawesi, it is not a pretty picture, and I look at it as a game of like China's paying off politicians, and politicians are sometimes they're getting influenced by the voters, and sometimes they're not. But if they are slowly getting an influence in there, then that is good for any other nickel projects that are not there.
Yeah, I mean, it's probably too far to say that every operator in Indonesia is not operating responsibly. And there definitely are some folks who are operating in a way that many would probably characterize as best in class. But there, unfortunately, it does appear that certain operations are
Less than ideal.
Environmental consequences to certain operations. But I think the winds do appear to be maybe not changing immediately, but there does appear to be some form of tightening around environmental standards, which is a good outcome, I think, for collectively as a society when we think about the impact of this sector on the world.
Yeah. Yes. Well said. Okay, going back to Voisey's Bay, so the cobalt stream. Patrick wants to know, do you expect the mill to clear about 85% nameplate requirement by the year end of 2025, so the next few months?
So that's been complete. They've achieved just under 94%, and an announcement to that effect went out within the past weeks. And again, it's why we feel really encouraged by the momentum we see at that operation. With that asset really does seem to be hitting its stride in terms of ramping up to full production capacity.
Okay, I missed that update. Shame on me. Okay, first on Voisey's Bay, at current rampant production, when do you expect to hit? Okay, well, you already answered that. And then production appears to be mainly alloy grade cobalt. Are you expecting stable alloy grades throughout the mine life?
Historically, we've seen a weighting towards 80-20%, although of late, they're absolutely, the viewer, or the question is absolutely correct. We've seen almost 100%. So for now, our expectation is that that's a intentional product spec that Vale is targeting, Vale-based metals, and that's expected to continue. There could be some standard grade products in the future. It's hard for us to predict, but based on our understanding, it does appear that Vale is really seeking to get that percentage of alloy grade as close as possible to 100%.
Okay. And Voisey's Bay may be larger than the current plan suggests. What's your guys' expectation for how long the mine could actually go on? What's the mine life?
Yeah. Well, if I may, I think when you look at the Ecora portfolio today, one of the things that excites all of us involved in the Ecora story is that you go from a revenue profile that used to be measured in years in relation to the met coal asset to royalties with lives that get measured in decades. It's a pretty seismic shift when you look at the continuity of this portfolio, but also the long-term benefit that you can see simply from inflationary pressures. This asset is expected to run just up until the end of the next decade on the reserve-based mine life, but there is certainly potential for this asset to run much, much longer by virtue of the ore body extending at depth beyond the current workings. So it's something to watch, and we have been to site. We see that potential. There's certainly potential that this mine could double its mine life beyond what's already in the reserve-based plan. And in that context, keep in mind that this operation was initially a sort of 20-ish year open pit. It was extended to a 20-year almost underground operation, and there's certainly potential that it runs much, much longer. So in time, we're very excited about hopefully seeing some of this information as a result in the form of resource work following exploration that will further support that potential. It's certainly something that is kind of new in our portfolio, though, right? When you think about the Kestrel royalty, investors have always pointed to a fixed mine life for that royalty being depleted and mining operations moving outside of our lands. So it's certainly something that we worked really hard to put into this business, a very long revenue profile for most of our assets that can benefit from multiple price cycles and generate returns far beyond the investment case potentially.
Okay, what other main assets, which do you think could have a longer mine life than people are currently estimating?
Yeah, many. If you go to slide number, we can.
Let's see. There we go. Which number?
Number 22, please.
22 coming up, sir. There you go.
So Voisey's Bay we've spoken about. Mantos Blancos we have not, but this is an asset that has seen its life of mine extended multiple times. It's an asset that's been in production for decades already, and there's certainly potential for it to go beyond its existing reserve base. Mimbula, we acquired this stream earlier this year, and there's certainly potential to run beyond the 11 years reserve-based mine life. Carlota is probably more constrained. Maracas mentioned this is an asset that's seen its life of mine extended from when we bought it, to call it 15 years today to 2050s. So substantial life of mine potential has already played through there. At this McLean Lake Mill, our tolling agreement here, the revenue is generated by virtue of the treatment of ore from Cigar Lake. And there is substantial prospectivity to extend the life at Cigar Lake into what's being called Cigar Lake Life of Mine Extension. 4 Mile, this is a 5-year reserve-based mine life. It's an ISR operation. As if you were to look at some of the disclosures of an Australian group called Alliance from almost a decade ago, you can see the substantial exploration and life of mine extension potential that exists. The company is now private, so there's fairly limited information in the public domain. There's absolutely potential that this life of mine runs far beyond the 5 years. Kestrel is an asset we think is quite constrained. The royalty coverage is over a portion of the mine plan. There's mining in the royalty area in some parts of the calendar year, outside of the royalty area, some parts of the calendar year. So there's a bit of volatility in that sense. And beyond the current footprint, we wouldn't expect substantial life of mine expansion potential there. EVBC is another producing royalty. This is a royalty that was acquired plus or minus 15 years ago. Their initial reserve-based mine life was, fairly short, and this asset has consistently extended its life of mine for, ever since then. So I think with gold prices being where they are, this asset certainly has the potential to keep running far longer than was initially the expectation when acquired, or probably a decade plus beyond their original reserve life, with potential to keep running from here. And those are the producing asset base. So that gives you kind of feel for the depth that this portfolio has. And so when you have a revenue profile in Kestrel, at $50 or $10 of Kestrel for a couple of years is certainly very different to $10 from a portfolio or assets that run multiple decades.
Yeah, and the commodities covered in that were cobalt, copper, vanadium, uranium, met coal, and gold. So a big umbrella of coverage there. And okay, also wants to know, are you actively looking for equity stakes as well? Would you ever consider taking a stake in something like Labrador Iron Ore Royalty Corp again if you found heavily discounted opportunities?
Look, at the end of the day, I think what we're looking for from a capital deployment perspective is, number one, materials and commodities that sit within this electrification suite, right? High purity materials, or materials that in some way or some part are expected to benefit from either GDP growth and electricity demand driven by GDP growth, urbanization, energy transition, energy storage, digital infrastructure, all of the above or some of the above, right? I think for us, we see a really attractive trend just driven by general electricity demand. And then from there, what we're looking for low cost ore bodies, and we're looking for attractive entry points. We're not in the business necessarily of picking the bottom and only picking the bottom, believe in paying a fair price for tier one assets. But we're also looking for, like any royalty company, long-term exposure to commodities that we see as offering upside through cycle and really strong fundamental outlook. In terms of the second part of the question around equity stakes, I think our primary business model is to buy royalties. We have at times in the past considered when we're acquiring smaller portions of equity in parallel to a royalty. Last summer, for example, we bought a royalty over a rare earth project called Palambora, which is expected to be amongst the highest margin rare earths producers globally outside of China once in production. That royalty was $8.5 million, and we also acquired a $1.5 million equity stake at the time of the transaction. So, at times where you can see our transaction being part of unlocking value on the equity side, we would absolutely consider it. But really, our primary focus is to pursue royalty and stream acquisitions.
Okay, so you're going to be focusing on the electric side, so picking up an iron ore one, probably not.
Yes and no. I mean, iron ore in many ways is a pretty fundamental commodity if you're thinking about electricity, right? I mean, wind turbines require a lot of iron ore, that's for sure.
Oh, that's a good point. Yeah, okay.
Right. So, you never say never. I think when we monetized our Labrador iron ore stake, it was basically sort of a cyclical trade where we saw potentially as an entry point something more attractive relative to iron ore, and that actually played out. So would we consider it? Possibly, but I think it's also relative to the opportunities that exist that would mean that we might have to forego were we to go into iron ore, for example.
Okay. And what are the expectations for G&A spending in the near term?
Yeah, I think on G&A as a royalty company, we're pretty lean. We're around 10 people in our head office. And as a royalty company, we've really sought to to benefit from the scalability that exists in the royalty sector, right? To manage a portfolio of 20 royalties, well, 5, 10, 20, 30, 40, 50, it's very, very scalable. I think what we've seen this year, unfortunately, is weakness in the USD GBP exchange rate. A lot of our costs are in London and thus GBP denominated. But we wouldn't really expect any material changes. And if anything, we're working hard to keep them flat or try to bring them down.
Okay. Yeah, I've noticed that the Great British Pound is outperforming the dollar. Let's see. Would you consider cutting or discontinuing the dividend to focus on deleveraging and acquiring more near-term producing or producing assets while you're still in growth mode?
It's the capital allocation framework we announced last year was really to come with a balanced capital return policy, but one that really allocated and emphasized growth and subsequent deleveraging. So we feel really happy about having adopted that policy, particularly given since adopting it, we acquired a producing copper stream, we acquired a tier 1 rare earths royalty, and that was really underpinned by the logic of updating our capital allocation framework with the objective of further diversifying our revenue profile. And we're absolutely in the future looking to continue to acquire royalties that, especially for large transactions where we have a great line of sight on the income profile. From here, the capital, the dividend level is set as a varying percentage of our free cash flow, 25 to 35%. And we think that policy offers quite a lot of flexibility in that if the business is performing exceptionally well, distributions increase. If commodity prices are down, just naturally distributions decrease with the balance of free cash flow ultimately going towards deleveraging. And to the point of deleveraging, we are really delighted with the pace of deleveraging that we've seen since the Mimbula transaction earlier this year. If one actually assumes research analyst consensus commodity prices as of August, which are probably a bit light compared to where people are coming out today in copper and cobalt, one would see it's expected that we finish the year somewhere around the net debt level of when we started the year, which would be a fantastic outcome. We would be very, very happy with this pace of deleveraging, considering we drew down on our facility to buy a $50 million copper stream.
Okay. What percentage is, how can I say it, unavailable to retail? So who are some vested partners that you have? What percentage of the pie can retail not buy?
Yeah, that's sort of a hard question to pin down because but I would say if the question is who if you're trying to exclude any sort of institutional investor, you're probably then around 50%. So I think that there's a big float in this company, and that the float is in by no way an impediment to any retail investor getting exposure, and any retail investor can do so either via our TSX listing, which trades on the ticker ECOR, on the OTCQX, which allows settlement on the LSE line or the TSX line. The ticker there is ECRAF, or on the London line ticker ECOR.
Okay, here's your lined stock chart here. This is going back, this is on the London Stock Exchange, going back to the mid-90s. And you guys had quite a fall here, and then recently had a nice bounce. So I hope it continues selfishly, and for you, sir, keep up the good work. I'm really excited about this one. I like the exposure that you guys have to the commodities that you do, and I think this goes right in line with our fundamental base case of electrification of the planet, and I think you're going to do quite well.
Yeah, well, that's really kind of you to say, so thank you. We've put a lot of work into sort of positioning this portfolio for, as I said, what we anticipated to occur. And you're really starting to see the price tailwinds and the number of commodities to which we have exposure. So we're very excited to see the rest of the 2025 play out, 26 and beyond.
Yes. What is the biggest unanswered question facing Ecora today?
Yeah, I think it's similar to the similar question that existed as of July when you asked me that, but I think it's a little bit with much more with a bit more clarity, and that really was: is the ramp up of Ecora's critical minerals portfolio going to happen, and if so, how fast and when? Right, and our H1 results just after we spoke, I think, went a long way to answering that question, to demonstrate the cash generation potential that exists in this business. And what we've seen is just the start from the producing asset base. So over the next 12 to 18 months, but certainly sooner as well in some ways, just demonstrating this with the actual cash flow generation, but also the key milestones events, I think will go a long way to underpinning the Ecora story. And as we see where we sit today, we have a lot of tailwinds and momentum towards answering that question by virtue of the performance of the portfolio, the assets, and commodity prices.
Awesome. Well, thank you very much, Mark. Any final words? If viewers want to get a hold of you and follow Ecora, how can they do so?
Yeah, if you have any questions, I would encourage you to reach out to ir@ecoraresources.com with an Ecora-resources. And we monitor that very carefully and endeavor to come back to anyone who raises a question. Our website is www.ecora-resources.com. You can follow us on, if you're into social media, on various social media platforms, and through the content that we produce with you, Steve, and others.
Awesome. Well, thank you very much, Mark. I wish you the best of luck. I am literally betting on it.
Well, it's great to have you with us for the journey. Thank you for your support.
You're welcome. Thank you. And thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.